So interest rates are unchanged because of fears of inflationary pressures persisting. We have an interest rate that's sitting at around 18%. Some say that the central bank should rather be forward-looking and being proactive. Do you think that this was the right stance, the prudent stance to take?
I think it's reasonable overall. I certainly don't see the central bank raising interest rates here. I think they're doing what they're supposed to do. I think this is why we pay central bank governors what we do, to take the heat, to take the pain.
James, if we could also just touch on what we've been seeing from a currency perspective. It's been relatively stable. We've seen a shilling that is holding its own. We saw a lot of pressure coming through towards the end of last year. Those were one of the reasons that we actually started to see inflationary pressures coming through on the food and the fuel front. That is now stabilized, and many are averting the question as to whether this kind of stabilization can remain in the market, given that we've seen so much intervention to keep the shilling at these levels.
Yeah, this is actually a balancing act. And you're absolutely right. Last year, the shilling lost 25% of its value in 3 months. And then it appreciated again 25% in the next couple of months. Yeah, this is a bit of a balancing act. And I'm sure the central bank is trying to determine whether or not they can reduce these rates and not have the exchange rate slip. Because as you know, Kenya is a net importer. And any slippage in the exchange rate is going to increase inflation. So they're watching this very carefully. It's interesting, though. They've kept the central bank rate at 18%, but rather dramatically, they've let the 91-day and the 182-day Treasury bill rate come down. Both of them in the mid 14% now. So yeah, it's a balancing act, but they're doing what they have to do. They're not entirely sure they can let this thing drop.
Okay, well, James, I mean, given the fact that you're talking about the T-bills there, and we've actually seen a drop there on the rate front, is this really indicative of the next move for the central bank, that we are going to see a rate cut? Some are even talking about a rate cut by the month of June.
By the month of when, Elena?
June this year.
June, yeah. Well, you know, I could see them testing the waters and dropping it to 17.5%, 17%. But let's put all this in perspective. You know, I'm old enough to remember the days when Paul Volcker broke the back of inflation in the United States, and he kept the Fed funds rate at 20% for 2 years. And the pain was so tough. I remember farmers driving the tractors up to the Federal Reserve Bank and blocking the bank. I mean, this is tough stuff. And where you sit depends on what you feel. A lot of people are feeling a great deal of pain, but I think he's doing this for the greater good. We just cannot afford to have the exchange rate slip again and have inflation grow, you know, take off again from its 13%.
Yeah. Okay, so I mean, just looking at some of the responses coming through into the market, James, it seems that some people are of the view that the central bank is being slightly too cautious, because as we mentioned and we've alluded to, the fact that T-bills are starting to, you know, look far cheaper than what we're seeing on the interest rate front, and then banks also coming to the fore and dropping their rates as well. So would you say that the central bank is slightly behind the curve?
Well, I think you've got to remember the central bank rate is the rate at which the central bank lends to other banks. There's not a great deal of that going on right now that I can tell. The rate that the government is paying for money, though, still are the Treasury bill rates. Those rates are coming down. So in effect, the government is actually reducing its servicing, its debt service fees, even though it's keeping this central bank rate at 18%. To some extent, it's it's a show rate. It's a rate everybody pays attention to, but it's not the rate that is costing the government. On the other hand, it does obviously play into the prime rate that banks lend their customers, which typically in Kenya right now is about 22%.
Yeah, and that's really high.
But as I say, the cost of capital is coming.
coming down, yes, James, and I mean,
Yeah.
and that's really high. I mean, we're looking at an interest rate of around 22%. Obviously, that would hurt the consumers quite extensively. And then you've got this other kind of, counter argument that's coming to the fore, that if we don't see rates dropping extensively in Kenya, then, the banking sector is not really going to have, fantastic earnings to show this year. And obviously, the consumer is also going to battle quite extensively. So you mentioned it's a balancing act. Give us an indication of kind of some of the scenarios that you're pricing in for 2012.
Well, look, generally, you got to remember that Kenya is an emerging market, frontier market. We can't have interest rates at 2 and 3% over a long period of time like we did a couple of years ago. In general, over the last 20 years, I would say, the mean average interest rate in Kenya is about 10%. I think inflation, a target inflation rate of 9% is still too high. Maybe something like 5% makes sense, but if we can get the central bank rate down to 10% over the next 12 months or so, that would be a good thing. By June, I would say that we might. It's taken us 5 months to drop inflation 5%.
Yeah.
It's probably going to take us another 3, 4, 5 months to get us down to 10%. So June is a little early, and maybe the central bank rate will be down to about 16% by then, if the exchange rate doesn't start to slip. If it starts to slip, it's going to ratchet right back up again, because we cannot afford to have that kind of price instability here.